Today, we're diving into the Japanese recruiting firm Gakujo, because their latest financial report has a real head-scratcher. Their sales are up, but their profits are down. Now, on the surface, that sounds like a problem, right? But as we're about to see, it might actually be the price of a really smart plan.
So, yeah, how does that even happen? How can you bring in more cash but have less to show for it at the end of the day? It's a classic business puzzle, and lucky for us, Gakujo's latest report gives us all the clues we need to solve it.
All right, so here are the top-line numbers. You can see sales hit 11 billion yen, which is up a decent 2.7%. Not bad. But then you look at the next two lines. Operating profit, that's the money they make from their actual day-to-day business. It fell over 12%. And net profit dropped by more than 15%. So more sales, way less profit. What on earth is going on here?
To figure this out, we're going to break it down. We'll start with this puzzling performance, then look at the two very different markets they're in. We'll figure out the price of their progress, check if their financial foundation is solid, and finally, see what this all means for the future.
Okay, first things first. We need to really understand what these numbers are telling us. To see why a dip in profit is such a big deal, especially when sales are climbing, we have to zoom in on one metric in particular.
And that metric is operating profit. Just think of it as a quick health check on a company's main gig. When this number goes down, it tells you that even though more money came through the door, the cost of actually running the business went up even faster. It basically means Gakujo got a little less efficient at turning sales into profit this year. And the big question is, why?
Well, the answer starts to click into place when you realize Gakujo isn't just one singular business. It's really a company with two different sides, and right now, they're heading in completely opposite directions.
And this slide just lays it all out perfectly. On one side, you have their Rishukatsu service. This is for young professionals who are already in the workforce and looking to switch jobs. It's absolutely booming. Sales shot up by over 28%. That tells you there's huge demand for workers with some experience. But on the other side, their service for brand new graduates, Rishukatsu Campus, actually saw sales fall by about 3.4%. The market for new grads is changing, and it's become a much tougher space.
So we've got strong growth in one area and a little dip in another. But, that alone doesn't explain a 12% drop in operating profit. To get that piece of the puzzle, we have to look at where the money went. And that's when you realize this wasn't an accident. It was a deliberate strategy.
This is where the story gets really interesting. Gakujo didn't just have random rising costs. They were making some very specific strategic investments. They spent more on promotions, more on training their own people, and, this is the big one, they rolled out the AI assistant Microsoft 365 Copilot to their entire staff. This is literally the price of progress, spending money now to build a stronger, smarter, more efficient company for tomorrow.
Now this whole spend money to make money strategy, it sounds great, but it can be super risky. So that leads to the next logical question. Can Gakujo actually afford to do this? Is the company's financial foundation strong enough to take this short-term hit to its profits for a potential long-term gain?
To answer that, we look at something called the equity ratio. It sounds technical, but it's actually really simple. It just tells us how much of the company is paid for with its own money versus borrowed money. A high ratio is a fantastic sign of financial strength. So, what's Gakujo's number?
An incredibly strong 86.9%. That is huge. It means the vast majority of the company is financed by its own capital, not by debt. They are on rock-solid ground. A number this high gives them the freedom and the flexibility to make these big strategic investments without having to worry about what the banks think.
And this isn't just a fluke, a one-time thing. If you look back over the last 5 years, Gakujo has kept this equity ratio exceptionally high. This isn't just a good year, this is a fundamentally stable company, and that long-term stability is exactly what gives them the confidence to make these kinds of big bets on their future.
Okay, so they've spent the money, and we know they can afford it. Now for the most important part. What's the payoff? What do they expect to get in return for all this investment? Let's take a look at their forecast for next year.
And here it is. This is what they're betting on. Gakujutsu is forecasting a massive rebound. They see sales jumping over 20%, which is great. But the really crucial number here is at operating profit. They expect it to surge by nearly 40%. They believe this is the direct result of the investments in AI, marketing, and training that they just made.
So, the company itself is clearly very confident in its strategy. But how do they translate that confidence into something real, something tangible for their investors?
Well, they're putting their money where their mouth is. The company is planning to increase its dividend payout from 67 yen per share all the way up to 75 yen. Let me tell you, increasing dividends is one of the strongest signals that management can possibly send. It says they truly believe in the profitable growth that's just around the corner.
So, let's wrap this up. Gakujo's profit dip this year wasn't a red flag. It was a calculated investment, spending money to pour fuel on its booming young professionals market and to make the whole company more efficient with tools like AI. And because they're backed by that rock-solid financial foundation, they're now forecasting a major profit rebound. The only question left is, will the market reward their bold strategy as handsomely as they predict?